Hello friends, welcome to this video on intraday option strategy using ADX and Super Trend. So I decided to create this video because a lot of people who want to trade options are worried that they don't know a lot about Greeks which are used in options, and that becomes a big hindrance for them. The other thing which stops a lot of people from trading in options is the experience that you may be right with respect to your view on the stock, but after taking an options position, you actually don't end up making money. So these are the two challenges which I have also faced while trading options. I've been trading options for more than 5 years now. But what I've learned through experience and through practitioners in the market, that there could be ways to deal with this handicap of not knowing Greeks. So I don't use any Greeks in my option trading strategy. And I will tell you with respect to each Greek that how have I been able to avoid using any of the Greeks and still trade options profitably. So after going through this video, I want you to take two or three things. I mean, what is important if you're not using Greeks in your option trading strategy? There are some limitations to it. So as traders, one has to understand limitations of any strategy. Secondly, at the same time, I want the fear within you to go away that, I mean, if I don't know Greeks, I can't make money using trading options. So these are the two important takeaways I want you to take away from this video. So without further ado, we'll move to our topic for today: intraday option strategy using ADX and Super Trend. So first and foremost, the Greeks, the things that scare all of us. So primarily option Greeks can be divided into, I would say, four categories, but we have five Greeks: delta, gamma, theta, vega, and rho. These look like big words. I'm not going to go into detail of the Greeks, but just to give you context as to what each Greek stands for, so that when we are designing our own strategy, we can see how we have been able to deal with the handicap of not knowing the Greeks. So first, delta. So delta deals with change in option price for the change in underlying. So when you're buying option, you are not actually buying the underlying. You are just buying an option to purchase underlying at a future date. So it's an optionality. It's not a real underlying holding that you have. So therefore, call options don't move 1:1 as your underlying share will move. So for example, if you're long call option on HDFC Bank, so for every 1 rupee move in HDFC Bank, you will not see 1 rupee move in your call option price, no matter if you have at the money call option. Now the movement will be lesser than 1 always logically. Now why that happens is because you still have time for expiration. So as an option comes to expiry, the thing that we call delta, that is the change in price and call option versus change of price in the underlying, that will converge. But that does not mean that there will be a one-to-one change in price. So to keep things simple, change in call option price will always be lesser than 1. So that is something that we need to understand, especially for at the money options. As you go in the money, the value of change in option price versus change in underlying converges to 1. Second is gamma. Gamma is rate of change of delta. Now, as I told you, at the money option don't move 1:1 with the underlying. But as you move in the money, the option price will converge 1:1 with the underlying price. Now, what it means is that the delta is not constant. The delta changes. And the rate of change of delta with respect to change in underlying price is known as gamma. So to keep things simple, delta and gamma deal with change in option prices versus change in underlying price. That's the only thing you need to remember for this video. Third is theta. Now, theta, everyone, all of us know that all options have a certain expiry period. So as we move closer to the expiry, there is a natural decay in option price. Because at the start of the month, your option will be consisting of two things. One is the intrinsic value and second is the time value. I'm not going into detail. You can Google it, what extra intrinsic value and time value means. But theta deals with the time value component, which goes to zero as you move further towards expiry. Fourth, Vega. All of us know options price goes crazy when there's a lot of volatility in the market. And Vega is basically a measure to see how much volatile the price of option will be with respect to change in stock price. So here we are not talking about the dollar to dollar change in stock price. If markets are very volatile, your options will be expensive. So as option traders, one has to be very sure that when prices of options are factoring in very high volatility, generally the practitioner says it's better to sell options rather than buy options. But in this video, we're just going to talk about buying options. We're not going to talk about any option spreads or any exotic way of dealing with options, because since we don't know these option Greeks, I mean, we can't do exotic things like butterfly, iron candle and all that. Moving on. So the last component is row, interest rate. Now this does not have like too much of impact when we are looking from a month to month period. So we can ignore it for now. Now, as I told you first thing at the start of the presentation that I don't know any of these five things and I'm still able to trade options profitably. But that does not mean that I don't know how am I dealing with the handicap of all these Greeks. So I'll go one by one as to how my strategy has been able to maneuver around these Greeks. Now, first part is how do I deal with delta and gamma. Now to take you back, delta and gamma basically tells you about what will be the change in options price for the underlying change in stock price. Now for that, what I do is I take trades only in at the money options. And secondly, because it's an intraday strategy, the delta doesn't change a lot if you are trading in ATM options. Because the thing with any smaller time frame is you will be looking at a smaller amount of profit versus a positional trade. But at the same time, the thing that you can benefit from is the deltas and gammas won't change materially unless like there's a massive spike in stock price or the underlying price. So here, how we deal with delta and gamma is we will only trade in at the money stock options, no out of the money stock options for the strategy. Moving on, the three big aspects, I've combined them together: the time decay factor and the volatility. And interest rate you can ignore, but I mean it's a very less confusing item as far as our strategy is concerned. So primarily, time decay is an issue when we are dealing with positional trades on options, and therefore we have to be very careful of taking naked options. A lot of people discuss on Twitter that buying option has unlimited potential of profit and very limited loss. Theoretically, it's true, but at the same time, one has to understand during what time frame your view is playing out. Because when you're buying option, you're not just betting on the direction, you're also betting on the time frame within which your view will play out. So because we are doing an intraday trading strategy, within the day, there's not much of a theta decay, barring the day of expiry. So I would suggest you keep your trades to minimal or don't trade on expiry days, especially the monthly expiry using this strategy. Because what happens is suddenly, if the volatility in general is higher in the market, what you would witness is after 12 p.m. or 12:30 p.m. at best, lot of options will start losing the value very fast. So the theta decay on the expiry day is super fast. So ideally, I would avoid trading on expiry days. Now this, by trading intraday only, I'm also able to deal with volatility in a form and fashion, because volatility doesn't change a lot, especially if I'm trading in index options, which I'm going to show you how I do that. So this volatility won't impact us much if we are trading in a shorter time frame. But yes, if you're taking positional trades, then you have to be wary of volatility, because I mean, nowadays we witness markets have a lot of gap ups and gap downs, and that can actually impact your position PNL or position MTM on the option side. Now, what I look for. So here in this slide, I have actually captured multiple things when I was making this strategy. So for this strategy, or as an option trader on the shorter time frame, there are a few things which I have to be very sure of. As an option buyer, we are not going to sell options in this strategy. It's a plain vanilla option buying strategy. So few things I want to clarify. First is it's a shorter time frame. So I want my view to materialize in that shorter time frame. So one, I have to bet on the right trend. Number two, the momentum should be on my side, because I want it to materialize within the day, because I will be closing my position no matter what my PNL is at 315. And lastly, I need liquidity. We'll talk about whipsaws later, but liquidity in options is like very important. And that is what a lot of people don't factor in as far as the cost is concerned. Below, I've actually shown you two cases. One is the Nifty index options, and second is HDFC's option spreads. Now, HDFC is a very liquid stock, but just to give you a context here, for Nifty options, pretty much you can buy or sell at a spread of 1 rupee. So your lot size is 75. So even if you don't get your price, at max, you lose 75 rupees on the execution side. Whereas even if any kind of a stock option in India, I mean, we don't have a very deep stock options market for most of the stocks. So when you are trading in stock options, I would strongly suggest trade only and only in at the money options, or better one in the money option, the nearest in the money option, because you will get some liquidity there. And specifically here, if you see in case of HDFC, the spread is close to 3 rupees. Now on a size of 300, 3 rupee will translate into 900 rupees per lot on an intraday basis. It's not a small cost. So one has to be aware. Other thing that I've noticed is in stock options specifically, that when if you're trading in illiquid options, despite the stock moving in your direction, you won't find bid and ask favorable to you when you're trying to square off your position. So for example, if I'm trading in a stock like, let's say, BHEL or SAIL, who have bigger lot sizes, but the liquidity is not there in those stocks, so the spread could be almost 30 to 40 paisa in these small stocks, and the lot size is in excess of 10,000. So if I'm making 6,000 on the lot, I'll actually give up 2,000 to 3,000 rupees just on the execution side. So basically my MTM will look very pretty when I'm looking my trading terminal, but when I'm actually executing it, half of my profit just goes away because of execution issues. So I would suggest you start this strategy only on index options to start with, and then as you master things, as you get hold of how to trade options in index, then you can move slowly to first the liquid options. There are very few in India. I mean, I would suggest stick to Nifty 50 options, and that to banking few names, or let's say FMCG few names, and Reliance and the likes of L&Ts. So to start with, don't jump into trading big lot options. They may look interesting, they may look that you'll be able to make money, but because there's no liquidity, there's a lot of inefficiency in that market. I hope I've made this liquidity point clear to you, because trust me, it's a very important point. And most of the articles that you see online, you won't find people discussing a lot on this. I mean, they'll just say that don't trade in illiquid options, but what kind of a P&L damage that it can do to you, that's very important for you to understand. So yes, so the strategy basically deals with the trend. So we will only be taking trades when our momentum and trend indicator are in sync. So for trend, what I do is I use super trend indicator. This is something that I learned very recently. I was earlier only trading using ADX as ADX crossovers, to be more specific, to take call and put options. But what used to happen is not all crossovers are same, and I ended up making money in big moves, but there were a lot of small choppy moves where I used to lose money, and I was trying to find out ways to filter those choppy moves. And one of the ways which I came across on internet is to trade only in the direction when the trend is on your side. So that's why I superimpose super trend indicator. So right now what I do is move to the next slide. So I buy, I'll be long on any position on the stock only when the trend is positive. So basically I'll buy a call option when the trend is positive on super trend, and my ADX crossovers also give me a similar signal. That is the plus DI. I hope everyone knows what ADX means. If not, I'll just take a quick 1 minute. So I'm just moving ahead just to explain you what ADX is. So if you look at this screen, we'll discuss it later. So it's a nifty chart, and this is a super trend. The blue line is super trend. So whenever the nifty is above this blue line, that means the nifty's trend is positive. And when nifty is below this line, it turns red, and Nifty is in a negative or a downtrend. So this will be our first decision point, whether Nifty is in an uptrend or a downtrend. Second is the DMI or the ADX, which I was discussing. So the blue line is a positive DI and red line is a negative DI. So when Nifty is in an uptrend and DI, positive DI is higher than negative DI, that means the blue line is above the red line, we will take long call options, and vice versa. And what I mean is vice versa is when there is a downtrend in Nifty and the minus DI is higher than the positive DI, we will take the put options. And we won't trade when positive trend is there, but there is a negative crossover on the DI. We won't trade these. So that's how we avoid the whipsaws. So exactly what I was telling you, for example, this could be a whipsaw, which we will be avoiding, because here the trend of Nifty is positive, but we are not getting a signal on the ADX. If I would have traded this, it would have hit my stop loss. So by superimposing super trend, what I'm trying to do is I'm trying to trade in the direction of the trend. Secondly, I'm trying to capture the big moves, and by trying to capture big moves, I will do a positive DI long option. Now, one should also be aware of the pace of move of DI, because what happens is, as I told you, momentum. So momentum is not just the crossovers of DI. The momentum in the ADX indicator or the DMI indicator is the pace of this ADX indicator, which is actually integrated part. If you go to investing.com, what I've done is I've separated them. You can do that as well. So I only take trades when the ADX indicator is about 20. See, if you see this line, I will only trade when the ADX indicator is about 20, and if it's moving up, it's well and good for me, because that means the market is coming into momentum. So for example, I will take a trade here, no matter if it's below 20, because it's an intraday strategy, right? So I will actually take a trade at this crossover, but I will only take one position at this point in time. Now, once it crosses this 20, that will actually confirm that the trend is positive, and the DI which is moving on the positive side has actually gained some speed. So I will increase one more lot only after the ADX actually crosses 20. So if you're doing a positional trade, you should stick to rule of 20. That is, you should only trade when the ADX moves above 20. But when you're doing intraday, you need to give yourself some leeway because this may not happen through the day every day, right? So here I'll just take one trade, then I will add one more position as soon as it crosses 20. Now what happens is there are two options. One is you can remain in the trend till that point you get another crossover or a trend change. All right. The other thing is as soon as you see the drift in ADX downwards, because it can't keep going up, right? I mean, it will actually hit a ceiling of 50 or 60 and then it will turn itself because momentum will slow down. Now, understand one thing, slowdown of momentum does not mean that the trend will change. What it means is, as of now, the market is taking a breather. It may go up again. So if you see here, the market didn't go below 20. They went up again. So what it means is that it just shows the speed of up move has gone down. Now, this is a very good indicator. Then once you start witnessing this, it's better to take your trailing stop loss closer to your current market price of the options. All right. So what happens is if the market actually turns sharply, you won't lose the money that you have made by playing this trend. So I hope it's clear till here. So I'll come back to this slide. I just actually explained you the whole trade there, but I'll go back again. So if you're positive on the stock, you'll buy a call option only when the trend is positive and your ADX is about 20. I explained you the ADX concept. And plus DI is higher than minus DI, and preferably I would like the DI to be higher than 25. So I've drawn this 25 line here. So if I'm trading for a positive direction, the plus DI should ideally cross this 25 to give me like a confirmation that yes, I mean, I'm actually correct and it's not going to just get whipsawed. So that also saves me whipsaws. Lastly, the capital protection point. Now I call stop loss capital protection point because it tells me that it is very important. A lot of us don't like losses, but what I've understood through trading is we don't know whether we are going to make profit or not on the trade. The only thing that we can control is the amount of loss that we can incur on a trade. If the strategy is right, sooner or later averages will catch up. We will make money in the trade. But what is in your hand is stop loss. So do not put any trade without putting stop loss. So my experience has been if you're trading intraday Nifty options, a 20-point stop loss is a good starting point. For Bank Nifty ATM options, a 50-point is a good stop loss point. So what I mean is, for example, if you're buying, let's say, Nifty call option for 10,400 at 90 rupees for the July expiry, so your stop loss point will be 70 rupees. Now this sounds like a very static number, but what happens is, I mean, as you trade, you will understand that your objective with stop loss is two. One is to protect your capital, but at the same time, you should not get whipsawed with market volatility. So I found that for Nifty ATM options to go 20 points down, that means Nifty has to turn around roughly 40 points because delta for ATM options is close to 0.5. Now, if there's a 40-point dip on Nifty in a very short span of time, you would see that pretty much the trend on the intraday side has changed. All right, and same thing with Nifty ATM option. So it's not a foolproof thing, but I mean, you will figure it out. You can change these numbers as per your convenience, as per your experience, as you start to trade more. For one thing, what I would suggest is what I've understood is for Nifty ATM options, try to keep it stop loss at 50 point and the limit at which the trade will get squared off at 5 points lower than this. For example, if I bought, let's say, Bank Nifty options for 500 rupees, my stop loss trigger point will be 450 and the cutoff price will be 445. Now what I've noticed is if you keep a random 447.5 or a 448, sometimes it won't hit your limit because Bank Nifty is so volatile that it's good to have that 5 point gap and it's a whole number. So pretty much your trade will happen. Otherwise, what you risk is if your stop loss limit order doesn't get hit, then your stop loss is activated, but the price will keeps moving low. So for example, let's say Bank Nifty has call option has reached 450, which is your stop loss trigger point. Now you put 447 as the limit order in stop loss. Now it may so happen that the bid ask moves from 450 to 445 directly. So basically you are exposed as far as the trade execution is concerned. And then if Nifty drops, Bank Nifty drops sharply, the Nifty option could be trading at 350, 375 before you can actually square off. So then you will rush and you will square off at market, whatever is available to you. And in this process, you will unnecessarily lose out on 30, 40 points on the Bank Nifty options. So what I would suggest is do one thing. For Nifty option, you can have a gap of 1 rupee. That's fine. For example, if you've bought Nifty call option at 90, you can set your stop loss at 70 and you can put a stop loss limit at 69. It will get executed because it's quite liquid. And for Bank Nifty options, if you've bought at 400, keep a stop loss as 350 with a limit price of 345 and you should be set. So keep these things in mind. These things are on the most of the times you will be enamored with the trade setup, the strategy, but execution is an equally and I would say sometimes more important part of any option trading or rather any trading strategy. Because at the end of the day, you want your MTM to materialize in your actual account. So I hope it makes a lot of sense. If you have any questions, do write to us at hellotcic@gmail.com. You will see the email ID at the end of the presentation. Now, similarly, moving on, if you are short on the stock, that is, you have a negative view, you will wait for the super trend to turn negative first. And similar other conditions remain similar, where minus DI now has to be higher than plus DI, and preferably minus DI should be more than 25. ADX preferred is more than 20, or you can work around with the position sizing, which I just explained to you. Now here also the capital protection point or what we know as stop loss remains the same. Now for intraday trading, I've tried multiple time frame setups. What I've found more peaceful, I would say, may not be 100% efficient. Some of you may come up with some more efficient things, is a 15-minute time frame. What happens is what we have to do is we have to take less trades, but more certain trades. Because every trade that you execute exposes you to cost of trading as well as stop loss. So the further you reduce the time frame, it's also a function of actually how much volatile the market is sometimes. So for example, on expiry day, if I'm trading, I will actually reduce my time frame to 5 minutes because I know I have to just go out in the market, make a kill and come out. But if I'm trading on, let's say, normal days, I think time frame of 15 minutes is I'm very comfortable with. I would suggest you also start with that. It gives you a lot of peace of mind. And when for executing any good trading strategy, I think peace of mind is the most important and most underrated thing that as traders we actually ignore. So I would strongly suggest that. Now I've already explained you this trade setup. I'll just go through it once more for the benefit of how I executed it. So I'm just going to take the trade which I took on the negative side, or basically about the put options. So here till this point, the super trend is positive. Now on this candle, the super trend has turned negative. Now just observe at this point, my positive DI is still falling. And my negative DI is actually given me a signal of crossover, but it's still not above 25. That's where I keep the signal of above 25 because what I see after this is there's a pullback. Now, I don't know when I'm in the real market, I don't know if this pullback will actually move the Nifty higher back into the positive trend or it's just a pullback in the negative direction and the Nifty downtrend will continue. So I will wait. So if you see there's a positive DI here in a negative super trend. So I won't trade this positive leg as well. So what did we do? We do two things. First is figure out the trend. Minus DI has crossed plus DI, but it's not about 25, so no trade. Then it slips back. Then positive DI goes up. So positive DI in a negative trend is a no trade zone. Now here again, now this market is picking up slight momentum as minus DI has now finally crossed the positive DI on the higher side with minus DI about 25. So I will start my trade here. If you see this horizontal line is where at the open I will take an at the money option. So here I will take 10,500 put option because the market here is 10,448, and because I'm taking put 10,500 put option will be the closest at the money option. You can also call in the money, that's fine. I mean, it's just nomenclature, but I would avoid taking 10,400 because it's a separate topic where but if you do some reading or Google, you will understand the cheapness and expensiveness of the option. So rule of thumb, if you're doing a trade, if the stop is 10,4, sorry, spot is 10,448, a put option should be bought of 10,500 strike price, which is higher. If you're doing a call option, you should buy a 10,400 call. All right. So here I'll take a 10,500 put option. All right. Then I will be in the position. Now ADX is above 20, although it's falling, it's still above 20 lines, so I'm not worried as much. I'll be in the trend. Now here, now this strategy has a limitation. Now what limitation is there is, for example, two things. One is this is close of the day. As you can see, there's a gap, so it has happened start of the next day. So I will close out my position here. So I started, let's say, from 10,448, and I've been able to capture like 10,312. It's a big move on an intraday basis. Now this is the exit on the intraday basis. Now there are next day, if you come, if the market is still in the downtrend, you will be worried. What should I do? Should I take the trade or not? Now that's actually function of whether you want to carry one option overnight because it's anyways there's a decent money that you've made on one option, or you want to just close out on both options. So that's your call to take. The other thing that I do is when I'm next day when I'm coming back into the market, I will wait for this pullback to happen. And see, sometimes, trust me, I mean, because it's a negative trend, which is a mature trend on a shorter time frame, you will get whipsawed. I mean, you can't escape whipsaws. So I will go on a shorter time frame. I'll look at 5-minute time frame to figure out if I can enter somewhere here and then can play this. I mean, it's an ideal scenario, but it may not materialize every day. So you have to then wait. Market will give you opportunity. All right. The other thing what you can do is if you have taken two put options, 10,500, what you should do is you should square off one option by end of the day, go to the higher time frame chart for a overnight trade. So look at 1 hourly chart, follow the same process. If it's in a downtrend, then carry one option home. All right. And guys, ensure that you can sleep well. If you, after the market close, if you are watching SGX, Nifty, Dow Jones, I would say it's not worth it. Better you close the option and go home and sleep peacefully, because it actually shows that we're trying to forecast too much that what's going to happen to my position tomorrow. I mean, no one knows. All right. So what are we going to do is we are going to close the option here at the end of the day, which will give us a very good profit. If 448 and 313, so it's roughly a more than 100% move. So roughly around 50%, even at a delta of 0.5, you'll be able to capture. So on a 75 Nifty lot, you'll be able to capture around 50 points, or actually it will be more than 50, but roughly on a conservative 3,500 rupees per lot on an intraday, you'll be able to capture with this move. If you go back, I'm not just selected this move because there you have made money, but if you would have traded this move as well, right? So you would have entered pretty much somewhere here close to 9,900, and you would have remained in the trend till probably here, till this. This would have actually ensured that you square off all your positions, but you entered at a very low level around 9,900 and this level is around 10,300. So 10 around 400 points of a straight move. So in any trend following system, the best money is made when there is a secular trend. So in a smaller time frame, what you can do is even if the market is consolidating on a higher time frame, you will be able to make some money on a shorter time frame. So that's why I choose 15 minutes here. All right. So this is the current Nifty chart. So what I will do next, right? So if the market opens right now on a 15-minute time frame, the trend is positive, plus DI is higher than 25, and the ADX is also turning. That is, the momentum has bottomed out, is slowly starting to move up. The ideal case for me would be if Nifty opens flat somewhere on Monday, I will take a long trade with one option. Then I will just monitor this positive DI, negative DI, and how the ADX behaves. So once I'm in the trade, now here it's around 10,400. So I will be taking a 10,400 call, and the ADX is already at 10,312. So technically, if the market reverses from here after I've taken the call option, so that is roughly around 80 points. No, yes, around 88 points, sorry. So 88 points divided by 2, which is multiplication by 0.5 for a delta. So roughly around 44 point risk I will be taking here. All right, which is, I mean, it depends on you. I mean, if it's a higher risk or not. So you may want to ignore this trend and you may want to watch out the market first and then trade. Or if there is a small pullback in the market where this DI situation doesn't change a lot, you may actually get a better bargain. You can actually go for a 10,300 call option and then be in the trade because we are still in the positive territory. Or if you don't trust markets will sustain, wait for it. Let it turn negative. Let this move up and then take a put option. All right. So this is how you can actually design your trade with options, and by trading intraday. See, we have not spoken about anything. Delta, the only reason why I've been referring to Delta multiple times is because it will give you some sense of as to how much profit can you make using this trade. So there's no selection criteria based on delta that I'm choosing options which have delta of let's say zero point 0.7, 0.81. So that's not the idea here. The idea is to just explain you as to what kind of a profit can you expect out of this trade. All right. So the limitation, as I told you, please remember that if you've closed out your trade, do not be in a hurry next day to jump onto the trend again because it could be a mature trend. Not all trends are like multi-day trends. Go to higher time frame, figure out what the market is doing using the similar model, and if you find a trade again, then go for it. But otherwise, wait for the market to turn. Market will give you opportunity, and what I've realized is doing a bad trade hurts your PNL more than waiting out. So we should also focus on avoiding losing trades and the bad trades, and profit will take care of themselves. So guys, so this is pretty much what I had for you today. I hope you've liked it. This video, if you like it, please subscribe to the channel TCIC on YouTube and click on the bell icon below to get live updates whenever I upload my videos. If you have any questions about this strategy or if you have any suggestions with respect to it, do write to us at hellotcic@gmail.com. We're also there on Twitter. Do follow us. We are not very active giving stock ideas. The idea here is to for everyone is to learn, and we are also learning by trying to share with you what we have learned through the course of our experience in the markets. I hope you have liked the video, and keep your ideas coming. We will be enthralled to hear from you. Thanks very much. Have a good day and stay safe.